All right, what's up, everybody, and welcome to the Jcam Alternative Investments Fund 2 overview. So Jcam is dedicated to providing passive income and growth through private real estate, providing you with a better way to build wealth without Wall Street. Starting first with the disclaimer, this is being recorded, so if you want to read this in its entirety, you can view it at a later date. But essentially, this is not an opportunity to invest. You must first read the private placement memorandum and the subscription agreement, and this is only appropriate for accredited investors. So the JKAM Diversified Real Estate Fund 2 gives passive investors the opportunity to build wealth without Wall Street. This is done by providing the opportunity for passive investors to invest alongside our firm into alternative investment opportunities, giving you passive income and growth, diversified real estate investments across multiple asset classes, markets, and operating partners, access to proprietary off-market deal flow, and tax advantage pass-through depreciation. So the JCAM Fund 2 will be opportunistically allocating towards these primary asset classes, which include multifamily value add, triple net leasebacks, industrial, mobile home parks, and self-storage. The JCAM Fund 1 has made allocations and investments in the highlighted states, and the allocations will look relatively similar in Fund 2 with a heavy focus in the Southeast and Southwest. The JCAM Fund does the due diligence that you don't have the time for, so we work on expanding long-term relationships with current operators and developing new relationships through our mastermind groups, industry conferences, and networking. We evaluate and underwrite the operator's experience, track record, and team. And if the operator and team is a go, we then evaluate and underwrite the specific project, including the business plan, pro forma assumptions, capital structure, and the property or project comparables. And then finally, we make or maintain close communication with the operator and team pre and post close. So the JCAM Fund 2 has equity and fixed share class options. As mentioned earlier, Fund 2 will opportunistically allocate to the following asset classes: multifamily, industrial, sale leaseback, triple net, mobile homes, and self-storage. The total raise is $20 million. The minimum investment is $50,000. The target preferred return is 6 or 8%, depending on the share class. And the target net IRR for equity share classes is a 15% plus, and the hold period is 5 to 6 years. So looking now at the 3 share class options, the 2 equity options are as follows. Class C pays a 6% pref, 70-30 split with a $50K minimum. The 70% goes to investors, 30% to the JCAM managers. The equity share class D pays an 8% pref, 70-30 split, and has a $250K minimum. And the one fixed share class option that we have is Class B. It's a 12% flat. 6% of it is a pref, and 6% is a catch-up with a $50,000 minimum on that one. So the waterfall for each share class is as follows. Class C, first, investors are paid or accrued their 6% quarterly from available cash flow. Second, investors' capital is returned pro rata each time we exit a deal until 100% is returned. Third, any remaining profits are split 70% to investors and 30% to the JCAM fund managers. The share class D, which is a 250 minimum, also an equity share class, is the same as share class C, except for it pays a 8% pref and has a 250,000 minimum. And the share class B, which is our fixed share class, the investors receive quarterly distributions of up to 6% on their active investment. Second, investors receive any accrued or unpaid distributions up to an additional 6%, totaling 12% flat. And then third, investors' capital is returned pro rata each time we exit a deal until 100% capital is returned. Looking now at what an example $100,000 investment looks like in equity share class C. So you invest $100,000. In year one, you receive a pref or preferred of 6% or $6,000. You'll see the same in year 2, again 6% on 100,000 and 6,000. And then in year 3, as there are dispositions or exits from some of the projects, we'll start returning capital. And then in this example, we return 50,000, so you'll receive your 6% pref for 6,000 and a return of capital of 50,000, totaling 56,000. And then in the 4th year, you'll get a $3,000 pref, which is 6% on your remaining $50,000 of capital that you have in the fund. And then we also return $25,000 that year in this example. So total for that year is $28,000. And in the 5th year, you'll receive $1,500 in pref, which is 6% on $25,000 you have remaining in the fund. And then we also return $25,000 of your initial capital or principal invested, totaling $26,500 for that year. And then in years 5 and 6, you'll receive 70% of profits after all capital and prefs have been paid. This works out to approximately 15% IRR. So we're really excited to be adding direct investment opportunities going forward. So in addition to our diversified fund, investors will be offered select direct investment opportunities. This allows investors the opportunity to invest directly into select properties or make custom allocations based on your preferences. Similar to our fund, this will be a streamlined process with a user-friendly, tech-forward platform and investor portal. So the Jcam team is fully supported by professionals who know their stuff, and we have strong relationships with established firms. So our fund accounting is done through Strategic Fund Services. We have tech-forward investor portals through Avestor for our direct offerings and Syndication Pro for our diversified fund. These platforms allow our clients to view fund and project updates, tax documents, and all the fund and project documents. Legal is done through Fisher Broyles, and finally, third-party oversight through Verivast, which does things like background checks on principals and verifies fund holdings. So as we move forward onto our second fund, we look forward to providing others with the following: education and content about alternative investments, access to private real estate investment opportunities that provide cash flow and growth, ideas and strategies on tax efficiency that our investors can discuss with their tax professionals, opportunities to invest alongside us and our best-in-class operating partners, and providing you with a way to take control of your financial future. So let's talk about the realities or problems passive investors face when investing in real estate. And the first is knowledge. So you have to know how to evaluate real estate, if it's a good investment or even meets the objectives of your investment goals. You need to be really knowledgeable about what asset classes to select, whether that's a single family rental, multifamily rentals, commercial real estate, ground up construction, what locations or geographies, what operators, et cetera, et cetera. The list goes on, making this a challenging proposition if you're trying to do this passively. The second is the time that it actually takes. So don't be mistaken by what you see on HGTV and home flipping shows. Real estate investing is not easy, and it takes a ton of time. So to do it effectively, you'll need to network and source opportunities, analyze and evaluate those opportunities, source the capital to fund the project, and the right team in place to execute on the strategy, and much more. And so after spending all that time working through the processes you need to have in place to be successful, you may end up with only 1 or 2 projects. And that leads to the third common problem, which is diversification. So most real estate investors get burned because they rely too heavily on one rental or one real estate syndication project. And when there's a bump in the road with a tenant or an operator, your return on investment is really impacted because you only have 1 or 2 investments. So diversifying among larger, more stable asset classes like multifamily syndications is also challenging because of the higher minimum investment requirements. Most real estate syndications are $50,000, and that means you need to have a significant capital outlay to achieve diversification, not just among operators, but projects, geographies, and finally asset classes. So Why invest with JCAM? So the JCAM fund provides a solution to those three major problems. So with our experience and expertise, you can participate in quality, stable, and risk-averse projects that are hard to source if you're not in the industry. Number two is, as an investor, you get a completely turnkey real estate investment. This means you're not dealing with tenants and toilets, the time it takes to source and evaluate opportunities, complete the paperwork for each of those projects or opportunities, and then having to deal with different K1s during tax time. And then lastly, the third is turnkey diversification. So with a single investment into our fund, you'll be diversified across best-in-class operators, projects, geographies, real estate asset classes, providing you with the advantages of real estate, which are high returns, cash flow, tax advantages. So I'd like to share the Fund 1 track record as an example of what you can expect from Fund 2. So Fund 1 opened to investors in September of 2020. Fund 1 allocated to 34 different properties. That actually needs to be updated. Sorry about that, guys. Primarily in the multifamily value add classes or multifamily value add asset classes. Fund 1 has had one project go full cycle already, and that was our project in Phoenix, Arizona, which sold in 12 months and 2 days, resulting in a 98% return on investment. And many of the properties are performing well above initial pro forma projections. And Fund 1 is now closed and Fund 2 is open. So here's a high level look at Fund 1 holdings. Again, there's 34 properties, 4 asset classes, 13 states, 22 metro areas, 12 sponsors, and 7,500 plus doors. Highlighting one of the Fund 1 allocations that has gone full cycle, and that was the Phoenix, Arizona multifamily value add project. Here's a look at some before and after pictures. This was a 282 unit multifamily value add investment that outperformed its initial projected returns by more than 75%, resulting in a 98% return on investment. Our experienced operating partner executed on their value add strategy to force appreciation in a booming Phoenix market and accepted an unsolicited purchase offer, resulting in the sale of this property in 12 months and 2 days. We have since invested in several other projects with this operating partner. Okay, so this could be a controversial subject, but we do think it's important to talk about, and that is your financial advisor most likely hasn't told you about private real estate for several reasons. And I'm speaking to this from personal experience because I was a financial advisor for years. And the first is they don't have the experience or expertise in private real estate or alternative assets because they're focused on products and services that they get paid on, which means their interests are not fully aligned with you. So unless you've paid a flat rate for planning, you're likely paying for assets under management or commissions on the products that they sell you, which in general are mutual funds, wrap accounts, annuities, and insurance. And in general, they are unaware of or not knowledgeable about alternative investments, potential returns, and risk profiles. They'll say, oh, that's really risky, or they don't perform as well as a balanced portfolio of stocks and bonds. And this is just not true. Let me go back there. In general, it is prudent to have some exposure to stocks and bonds because of the liquidity benefits. But I would recommend index funds because of the lower fees and the fact that actively managed funds never consistently beat indexes. It is also important to have a percentage of your investable assets in real assets that are not correlated with public markets and thus not subject to the volatility that you see in the Wall Street casino. So in general, the wealthiest people and families haven't gotten there on advice from their financial advisors or their 401ks or employee-sponsored retirement plan. They become wealthy by owning businesses and real estate, period. I would encourage you to take some time and do some research and learn about all the different options you have. With the amount of free and available resources these days, you can take control of your financial future. So what most financial advisors do understand and will recommend is the Real Estate Investment Trust, or REIT. This is almost certainly what a conventional financial advisor, even a well-meaning one, will suggest when you ask about real estate investing. A REIT, contrary to common perception, is not a direct investment into real property. When you buy shares in a REIT, you buy shares in a real estate operation. And REITs can invest in nearly any type of real estate operation, but tend to focus on large commercial assets in popular sectors like healthcare facilities and multifamily. The myth about REITs is that by investing in them, you are diversifying away from stocks. And this is patently untrue. You are still investing in shares, and REITs tend to follow the stock market. Unfortunately, investing in REITs will not enable you to shed the painful stress and Wall Street worry that you have experienced while investing in public markets. Additionally, REITs are often very inefficient for tax purposes for accredited investors. The reason is that REITs are not taxed at the corporate level by design. This means that their dividends are passed through to investors at ordinary tax rates. So if you're in the highest tax bracket, REIT dividends are actually taxed at 29.6%. This is compared to real property or private real estate funds, where distributions are typically completely tax deferred until the property sale. So Jack and I's aha moment was when we discovered that we could get mid-teens to low 20% returns with relatively low risk. Then we discovered that it was actually safer and more efficient to partner with experienced operators and work together to buy 100 to 300 unit apartment complexes. We were also blown away with how much time, stress, work, etc. we saved by being a passive financial partner in a real estate syndication versus operators. We also realized that we could invest passively and still get tax-deferred income due to depreciation. So speaking now to the depreciation benefits, one of the key benefits of real estate investing is the depreciation of the buildings, which passes through to the investors of our fund and can offset the returns that our investors earn. So this is done by cost segregation. So our operating partners complete a cost segregation study, which allows for the depreciation benefit on the properties to be accelerated from the typical 27.5 years to a much shorter time frame, like 5 years. So the depreciation on the Jcam multifamily assets in Fund 1 has ranged between 50 and 90%. So for an example, our Jacksonville, Florida project received a $462,000 depreciation benefit on a $500,000 investment. So one of the some of the feedback that we've been getting from our investors is some current concerns that, with the significant appreciation of real estate assets and potential economic headwinds, many investors are citing interest rates, inflation, and compressing cap rates as cause for concern that we are reaching a peak in real estate pricing. We are consistently evaluating and monitoring these economic factors, and want to highlight a case study that was covered by Jack's MBA program at Kellogg that has proven to be successful, even backtesting nearly 100 years to the 1929 stock market crash. So in this case study or example, if you invested $100,000 the day before the 1929 crash, it would have taken approximately 11 years to break even. If you instead invested equal installments monthly, 6 months before the crash and 6 months after, you would be even in roughly 2.5 years. So with proper diversification, when, not if, we experience challenging market conditions, a diversified fund with programmatic dollar cost averaging is a safe way to earn solid passive returns regardless of what the economy and capital markets are doing. So looking now at the Jcam team, Jack Krupe, principal, he leads the operations and asset management for Jcam. He oversees the strategy, operations, business plan execution, and reporting for over 7,500 plus units. Prior to Jcam, Jack led the asset management arm of a firm that made over $3 billion in purchases of non-performing and reperforming mortgage debt. Jack received his dual MBA from Northwestern, Kellogg School of Management, and Hong Kong University of Science and Technology. Next is myself. I lead the business development and marketing for Jcam. I oversee the planning, development, and implementation of the Jcam marketing strategy. Prior to Jcam, my company, Infinity Asset Ventures, LLC, acted as the exclusive disposition trade desk for Jack's prior firm. I received a bachelor's in finance and real estate from Colorado State University. Zach Dronoff is our COO. He oversees operations, acquisitions, and investor relations. Prior to Jcam, Zach worked for over 5 years in residential real estate sales in both New Jersey and New York, across functions including research, marketing, and sales. Zach received a bachelor's in business administration from Boston University. And lastly is Uni Min. She's our CFO, and Uni leads the auditing, compliance, corporate finance, and strategy. Prior to Jcam, Uni spent the majority of her career working in financial services, including a Wall Street broker-dealer, a registered investment advisor, an institutional mortgage valuation company, and in retail financial advisory. Uni received her MBA in finance and strategy from University of Rochester. So looking now at our experience on a timeline, starting in 2001, Jack started buying real estate, focusing on single family and multifamily rentals. In 2008, he joined a New York City private equity fund, which was buying distressed mortgages from banks. And in 2010, he launched Gemini Capital Advisors. And in 2014, partnered up with a large private equity that, as I mentioned earlier, made over $3 billion in purchases of non-performing and reperforming mortgage debt between 2014 and 2019. And in 2019, Jack and I launched the Jcam Fund. Missing here is what we've been up to in the present. So we closed Fund 1 in beginning of 2022 and now have Fund 2 open and live. So if you'd like to see more detailed information on the fund offering, you can go to jcaminvestments.com/offerings and create an account to view the confidential offering. Thank you for joining us today. If you have any questions, comments, or feedback, we'd welcome hearing from you. Thanks so much for joining us and have a fantastic day.